In times of financial uncertainty and instability, it is important to know the lessons learned from past crises. In this video, we will examine 10 important lessons from past bank crises. Lesson 1. Understand the banking system and its risks. Exploring the complexities of the banking world can grant a profound insight into the numerous risks it encompasses, such as credit, market, and liquidity risks. These risks have the potential to create a domino effect that could wreak havoc on both the financial system and personal accounts. To prevent such a calamity, it's vital to stay vigilant and informed about the latest developments in the banking industry. Recognizing the red flags of an impending crisis can enable you to take the necessary steps to secure your finances. This involves keeping a close eye on economic indicators, scrutinizing the actions of financial institutions, and comprehending the operations of regulatory bodies. Lesson 2. Avoid over-reliance on debt. Excessive debt can quickly become a slippery slope towards financial ruin during a bank crisis. While borrowing can help finance big-ticket purchases or investments, it's crucial to manage it responsibly to avoid falling into a debt trap. Uncontrolled debt can snowball, resulting in missed payments, defaults, and a hit to credit scores. To steer clear of over-reliance on debt, one must adopt a frugal mindset and prioritize saving. This involves setting a budget that accounts for all expenses and income, while allocating funds for saving goals such as emergency funds, retirement, and long-term investments. It's also vital to be aware of the interest rates and fees associated with borrowing, which can quickly add up and hamper debt repayment efforts. Another effective method of avoiding debt over-reliance is diversifying income sources. Having multiple income streams can reduce dependence on a single source of income and establish a more robust financial base. This could entail exploring a side gig, initiating a small business, or investing in stocks, bonds, or real estate. Lesson 3. Monitor and understand the economy. To navigate a bank crisis successfully, one must have a keen awareness of the economic landscape. The economy is a constantly shifting terrain that can be shaped by a variety of factors ranging from the mundane to the catastrophic. To stay ahead of the curve, one must be vigilant in tracking and interpreting key economic indicators such as GDP growth, inflation rates, and joblessness figures. However, it's not enough to simply collect data. One must also understand the nuances of economic trends and how they interconnect with the banking system. For example, if there is an unexpected drop in GDP growth, it could trigger a credit crunch and lead to a rise in non-performing loans. This, in turn, could create a domino effect that could cripple the financial system. Furthermore, global events such as trade wars, political instability, and pandemics can also have significant impacts on the economy and financial markets. One must keep a close eye on these external factors and be ready to adjust their strategies accordingly. Overall, having a comprehensive understanding of the economy and its intricacies is key to weathering a bank crisis and emerging unscathed. Lesson 4. Beware of speculation and risky investments. One must tread carefully when considering speculative investments, as the promise of high returns can sometimes lead to significant losses. To avoid the risks of speculative investments, it is important to conduct thorough research and analysis before making any investment decisions. This may involve examining market trends, evaluating financial statements, and assessing the potential impact of economic and political events. Diversification is also key in reducing investment risk. By spreading investments across different asset classes, industries, and geographical regions, investors can mitigate the impact of market volatility and limit their exposure to any one particular investment. This may involve investing in a range of assets, such as stocks, bonds, real estate, and commodities. It is also important to remain wary of investment opportunities that promise high returns with little to no risk. These types of schemes are often fraudulent and can lead to significant financial losses. As a general rule, if an investment seems too good to be true, it probably is. Lesson 5. Keep adequate cash reserves. Before we dive into the topic at hand, I have a small request to make. If you're enjoying this video, I'd greatly appreciate it if you could show your support by subscribing to the channel. This way, you'll be the first to know about future content and updates, and it will also help us reach a wider audience. Thank you for your consideration. Ensuring that you have adequate cash reserves is an essential aspect of surviving a bank crisis. During times of financial instability, having enough cash on hand can help you navigate the storm without being compelled to sell investments at a loss or borrow money at high interest rates. One strategy for building and maintaining cash reserves is to create an emergency fund that can cover your living expenses for a few months. This can act as a buffer in the event of job loss, illness, or other unexpected financial emergencies. Another way to maintain cash reserves is to diversify your investment portfolio with cash and cash equivalents such as savings accounts, money market funds, and short-term bonds. These types of investments are known for their liquidity and stability, making them useful tools for maintaining cash reserves. It's also crucial to review and adjust your cash reserves regularly. This involves reassessing your emergency fund and investment portfolio periodically to ensure that you have enough cash on hand to weather any potential financial storms that may arise. Lesson 6. Choose your bank wisely. To avoid potential financial disasters caused by a bank crisis, it's essential to carefully select the right bank for your financial needs. Not all banks are created equal, and you need to do your research to find a stable and secure bank that provides the services and features you require. When selecting a bank, the first thing to consider is its financial stability and security. You can do this by analyzing the bank's capital ratios, asset quality, and other key financial metrics. You can also check its credit ratings to gauge its overall financial strength and stability. It's also essential to consider the bank's deposit insurance coverage. In the U.S., deposits at FDIC-insured banks are protected up to $250,000 per depositor, per account type. This guarantees that your money will be safe and secure, even if the bank fails. Another factor to consider is the bank's customer service and reputation. Look for customer reviews and feedback to see if the bank provides quality customer service and has a good reputation within the community. Lastly, consider your own financial needs and preferences when selecting a bank. This may include factors such as account fees, interest rates, online banking features, and other services that are important to you. By doing your research and choosing the right bank, you can protect your money and ensure your financial stability. Lesson 7. Understand the role of government and regulators. To navigate a bank crisis successfully, it's crucial to understand the complex relationship between governments, regulators, and the banking industry. These entities work together to maintain the stability and safety of the financial system and to prevent potential crises from escalating. Regulators oversee the banking industry, enforcing rules and regulations to ensure banks operate in a safe and sound manner. Governments may provide financial assistance to struggling banks or implement policies to stabilize the overall economy during a crisis. However, government intervention can also have negative effects, such as creating moral hazard, a situation where banks may take excessive risks, knowing that the government will bail them out if they fail. As such, finding the right balance between government intervention and market forces is critical in maintaining a healthy and stable banking industry. Lesson 8. Stay calm and don't panic. When it comes to surviving a bank crisis, one of the most important lessons is to keep a level head and avoid giving in to panic. While it's understandable to feel anxious during times of financial uncertainty, it's crucial to remain calm and focused on making informed decisions that will help protect your finances. One effective strategy for maintaining calm during a bank crisis is to avoid sources of information that may only serve to fuel anxiety and panic. This could include sensationalized news reports or rumors spread on social media. Instead, seek out reliable sources of information, such as government reports or expert financial advisors who can provide unbiased guidance. Another important strategy is to have a plan in place for managing your finances during a crisis. This could involve creating a budget, prioritizing essential expenses, and exploring alternative sources of income or financial support if necessary. By having a clear plan in place, you can help alleviate anxiety and feel more in control of your financial situation. Ultimately, staying calm and focused during a bank crisis is key to making sound financial decisions and protecting your assets for the long term. Lesson 9. Be prepared for a bank run. Surviving a bank run requires vigilance, preparation, and understanding of the underlying causes. Bank runs can be triggered by a variety of factors, such as economic downturns, political instability, or rumors of bank insolvency. Being aware of these potential triggers can help you anticipate a crisis and take appropriate steps to protect your finances. One important step is to diversify your assets and spread them across multiple banks or financial institutions. This can help mitigate the risk of a total loss in case of a bank collapse or other financial crisis. Another strategy is to maintain a cash reserve in a secure location, such as a safe or a trusted friend's house, in case you need access to cash during a bank run. It's also important to stay informed and seek reliable information sources, such as government reports or trusted financial experts. Avoiding rumors and sensationalized news reports can help you stay calm and make informed financial decisions during a crisis. Finally, understanding the role of government and regulators in managing a bank run can help you have a better grasp of the potential outcomes and options available to you. Governments may take actions such as implementing deposit insurance programs, providing financial assistance to troubled banks, or implementing measures to stabilize the banking system as a whole. Lesson 10. Learn from the past and plan for the future. Throughout history, financial crises have had profound effects on individuals, businesses, and the broader economy. Therefore, it is imperative to draw lessons from the past and prepare for potential future crises. To learn from the past, it is necessary to examine the causes and consequences of previous financial crises. By comprehending the underlying factors that led to these crises, we can recognize warning signs and take measures to mitigate potential risks. We can also learn from successful crisis management strategies and incorporate them into our own approach to managing a crisis. Planning for the future requires taking proactive steps to manage risk and shield ourselves from potential crises. This may involve diversifying our assets, establishing savings reserves, and investing in assets that have been proven to be robust during previous crises. It is also important to stay informed about changes in the economic climate and to be ready to adapt our financial plans and strategies accordingly. Moreover, planning for the future entails advocating for policies and regulations that foster financial stability and safeguard consumers from predatory practices. This may entail supporting measures to enhance transparency and accountability in the financial sector or advocating for more robust consumer protections.